The Consumer Bankers Association is pleased to welcome you to today's webinar, Compliance and Risk Management Innovation, the Key to Growth, presented by Bridgeforce. My name is Sandy, and it's my pleasure to be the facilitator for today's event. I'd like to formally welcome the participants who are joining us today. Please note that today's call is being recorded and all participant lines will be muted during this broadcast. If you experience technical difficulties with the web portion of today's program, please email cba@compartners.com or send a message in the chat box. If you are listening to the program over the phone and you need assistance at any time, please press *0 and an operator will assist you. This presentation will last up to 60 minutes and will include question and answer opportunities at the end. However, you may submit a question at any time by typing into the chat box at the lower left corner of the screen and clicking on the send button. Today's presentation also includes live polling questions. When a poll appears on your screen, simply click in the box next to the answer of your choice. Your answers are not viewable by the other attendees. I'd like to direct your attention to the links box located to the left of the screen where documents and resources are located for you to view, save, or print. Simply click on the link of your choice and a separate web browser window will open. This will not interfere with your viewing of the program. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CBA or its members. And now it's my pleasure to introduce today's speakers. Andrew Domino is COO and International Executive Director at Bridgeforce. With over 20 years of experience in the financial services industry, Andrew has a long history of improving international organizations operationally and strategically. As COO, Andrew oversees the operational systems and staff for the consultancy while also working with domestic and international clients. As the Executive Director of International Practice, he has expanded the company's international presence. John Sanders is co-founder and Managing Director of Non-Bank Lending Capital Markets at Bridgeforce. John has over 20 years of experience, including progressive management positions in financial services. His career encompasses successfully starting and profitably running business ventures, including co-founding Bridgeforce, a specialized consulting firm to the world's top lending institutions. Andrew and John, welcome to the program. Let's get started.
Thanks, Sandy.
Thank you. Great, thank you, and welcome everyone to our webinar today. This is John Sanders, and we had the privilege of speaking on actually a couple of topics at CBA Live just a few weeks ago in Texas, and this was one of the subjects we covered. We were quite pleased to see that our session was at full capacity then, and the feedback received was very positive, and therefore we felt it would be nice to deliver this again in a webinar format. And we have actually tweaked this a little bit since then, to include some additional bonus material. So for those who attended at the conference, we thank you. And of course, if this is the first time listening in, we thank you for your interest and hope that you get value out of this today. The goal today really is, and the objective of our session is just simply to ensure everyone is better prepared for growth by leveraging the compliance and risk control foundations built in recent years. And when we look at this, we realize it's been a heavy investment for many, and we'll hit on that a little bit more in a moment. Enhancing and leveraging these foundations is quite valuable. There's talk of doing lots of cool things, if you will, digitization of the consumer experience, transforming the way we look at underwriting, redesigning the way we manage defaults, so on and so on. But the truth of the matter is this is only possible by having the proper risk and compliance pieces in place. We view these as prerequisites, and often you'll hear us affectionately call that the price of admission, which gets us to our third claim today. We can leverage what's been built out to further our innovation efforts. And we would even submit that not having the right components in place is not just a matter of compliance at this point, that we would suggest that without them, there's risk of being left behind competitively in the industry. Before we move on, I should take a moment to provide a fast download about who we are, just to provide context to our perspectives. We had the benefit of doing so at the conference, so I'll take a few seconds now. Bridgeforce is a management consulting firm. We're headquartered in the U.S. with offices in the U.K. We've been around for nearly 17 years, although several of our team members have been in the industry considerably longer. We are laser focused on consumer and small business lending, and to a lesser extent payments. And of note, we consult in all areas of the credit life cycle: acquisition, portfolio risk management, collections, recovery, and most everything in between. We also consult across all asset classes and the entire credit spectrum, from super prime to deep subprime. And finally, our clients range in size from large banks, Sandy mentioned, to fintech and specialty finance lenders, community banks, and even global financial institutions. And I share that because as a byproduct of where we traffic, we feel we have a nice crow's nest view of the industry, not to mention we live and breathe this daily, so we see the real-time changes in our clients' focus. Lastly, of note, we've also incubated some new solutions in the absence of some in the market that we'll refer to later. So essentially in the next hour, you'll be hearing what we like to call perspectives from the front lines. And today we will kick off with a question. Hopefully everyone can see this. Compared to what you've done in the past, how much attention will your organization put towards risk management over the next 12 months? And as you're clicking your response, we're going to quickly follow up on one related to compliance, if that impacts your thinking. We'll give this a minute. Okay, numbers are settling into a final spot. Well, it looks like clearly, directionally, the lion's share of responses are item C, more effort. Okay, very good. And then the follow-on question, compared to what you've done in the past, how much attention will your organization put towards compliance over the next 12 months? We'll give it another moment. Okay, it looks like the responses have settled. Actually, that's a bit surprising. I think it's consistent with many of our conversations with clients, but we have here our first bit of bonus material to share today. What you're seeing on this slide are polls taken at the kickoff at CBA Live, and we actually have a year-over-year look, 2016 versus 2017. And actually, after we designed the information that we've prepared for the conference, a couple of highlights here. We see that there is an uptick from 2016 to 2017 in focus related to innovation and creation of new products and solutions. And we also see from the CBA poll from the industry a slight reduction in the response to the compliance question, and an slight uptick in the last bucket, attracting a new generation of consumers and employees. So just some food for thought, and we'll happily share this information post the webinar. So as we think about foundations and prerequisites, we all appreciate, as I mentioned in my opening remarks, that there's been massive investment that's been poured into compliance. So compliance management systems, certainly lines of defense, well-documented policies, procedures, process maps, just flashing a few examples up here, but it gives an appreciation, I think, of just the massive amount of work that we've seen our clients pour into compliance and controls over the past few years. And even with evidence-based controls, we still see a focus on the importance of having to prove what you have. So it's great that things are under control, but now you have to prove it. And literally the adherence to an alphabet soup of regs that continue to grow. And we've worked with clients on literally all of these at some point. And any one of these, FCRA, we could just pick from this picture, UDAP, FCRA, they could each be an animal all to itself. More recently, credit bureau reporting and disputes handling has been and continues to remain a major focus in our industry, of course, given its importance, and vendor management. Certainly, we can all outsource many things, but we cannot outsource responsibility, and vendors are an extension of the business. Underwriting consistency and model governance, and most recently, proper controls around incentive structures. And while these foundations may have been put in place due to regulatory concern, today we'd like to take a different angle and point out how they can be leveraged for other value. And as one of my colleagues simply tells his children, do you want to eat your main meal first or your vegetables? And either way, you've got to eat your veggies, right? So by example, the fintech players, of which there are many, and perhaps some are on the phone today, and many of whom we know, they've enjoyed a period of time that I think is actually fast changing. And what I mean by that is we've gotten to work on probably some of the cooler and fun things, and several haven't had time or haven't had to spend, frankly, as much time on compliance and controls. And by making that statement, I certainly am not suggesting they don't have compliance and control programs in place. But from our vantage point, undeniably, they've not yet experienced what many of the incumbent players have had to go through. And when we think about it, this can be good news for those who have some of these big pieces in place. And we're now seeing a focus shift towards optimizing these compliance and risk management foundations within lenders. Namely, they were largely built in response to firefighting. They were not necessarily built in response or constructed with the thought of efficiency. And the momentum shift with regard to new and innovative product offerings and customer experience is in fact already occurring. When you think about the customer experience, from the targeting of the consumer through the portfolio management and back-end servicing as illustrated in this slide, all things must be connected. And if you think about it, you don't want to market the customer through digital channels and then put them through a cumbersome process in underwriting and so forth. And it's similar, if not the same as compliance. Compliance is also a coordinated journey, and all points must be talking to each other. And I like to use FCRA, for example. If you have a service member who gets deployed, that person is entitled to obviously certain protections as well as benefits. And our clients who have gotten FCRA to really a best-in-class state, they've managed to connect all of these dots across and through the entire credit life cycle, truly through coordinated data and risk management, and they look at the customer in a holistic manner. And in my example of FCRA, if you have a service member that may have an auto loan, for example, obviously there's protection. If they get deployed, maybe they're applying for a credit card and they get to enjoy a benefit in the form of a reduced rate. Holistic view, we don't think in terms of benefit and protection, we just call it FCRA relief. With that, I would like to turn the next segment over to my colleague, Andrew. Andrew, would you kindly take the helm?
Sure. Good afternoon, everyone. I'd like to start off with our second poll question, and that is selecting the biggest obstacle to growing your business. So if we could just give a minute there for everybody to read the answers and to reply. Right, so this one looks like it's a little more evenly distributed, but we are leaning towards maintaining, creating an efficient and effective customer experience. And we'll glad to see that because we're going to touch on that here in a moment. I'll just give it another minute for any other responses to come in. Okay, great. We'll also touch on how to generate that mindset or urgency internally around innovation in various areas that's going to be required in order to continue to grow and keep your business relevant. I'd like to start off by talking about 4 areas where we are seeing and hearing a renewed focus on innovation with our client. And the first one is simplifying and digitizing your customer journey, so that relates back to the poll question. We'll also get into refining underwriting, the need to reimagine collections and how collections operates, as well as automated compliance checks. And for the first example around simplifying and digitizing customer journeys, I'd like to go through a case study related to a mortgage customer journey redesign we did for a lender in the UK. And if I could just take a few seconds to talk about how mortgages work in the UK, it's quite a bit different than in the US. There really are no 15 or 30-year fixed mortgages in the United Kingdom. They tend to be 3 to 5-year terms. So customers are having to reapply to maintain their interest rates with their existing lenders on a consistent basis. So it's a regular occurrence. And with this example, we were brought in the first place because our client was using recently placed KPIs in response to new mortgage regulations, so new regulatory environment. They noticed that there was a degradation in the completion rates they had for mortgage applications. So items such as early warning self-identification dropouts, which basically was their existing control infrastructure, yielded information that wasn't just about compliance, it was about the fundamentals related to the customer experience. And those results brought this to the surface. Through our redesign discussions, we identified that there were multiple enhancements that could be made, including improving upfront applicant questioning, adjusting the advisor appointment scheduling, making advice conversations more meaningful, and advice in the UK means talking about what's the right product for the client. Enhancing process controls to ensure that the customer is ready for the next stage of the process, and improving customer communication generally. So after executing these opportunities during an 8-week pilot, we saw some pretty impressive results. Revenue increased by $10 million a year for our client. The journey time was cut in half, and that's the end-to-end, from the time of application to the time of mortgage fulfillment. Perhaps one of the best statistics was that missed advisor appointments fell from 13% to 1%. So this was a digital lender. They did everything either online or over the phone, although there were some gaps in their online offering. Customers would schedule appointments but often missed them, so we were able to reduce that down to 1%. The decline rate at the advisor stage fell from 11% to 3.5% because the customers were better prepared when they had their appointments. And this is a great statistic. The inbound status call volume fell from 50% to 5%. And what we mean there is customers calling in, chasing the next step of the process. Because we were able to implement increased customer education and awareness and shortened the actual journey, that inbound call stat dropped. So 50% of the volume for where am I in the process fell to 5%. And we also saw a 7-figure reduction in annual expenses through this optimization. What this essentially did was enabled the client to exceed their lending target by 20% using the same resources, but through 11,000 fewer phone calls and advice appointments. So once the journey was simplified, it made it easier to digitize. And we are currently working with the client to do that. So we're helping them design and implement a system which is an online portal to support the transfer of evidential documents, to provide proof of identification for the underwriting process, and also to act as a case tracker for the customer so they can log in and see what stage they are in the application and don't have to call in prior to going to the next stage. We have had a number of successful social media posts, including one from the client. This was the Chief Compliance Officer, who was actually a customer of the bank and knew that we were revising the journey, but saw that it went from a 4-hour journey to a 2-hour journey, and was really quite impressed with that process. And here, I think the message here is, we didn't use technology in the first instance. In the first instance, it was examining the existing customer journey and finding out what those tweaks were that we could make in order to improve the process. And then on the back end, what we are currently doing is enhancing the technology. So to improve your customer journey, to digitize doesn't always mean a new piece of technology. It can absolutely mean just improving the process that you currently have. So what can you do right now to improve your customer journey? By executing on efforts to be compliant, which we've all been on, we have really developed an understanding of what the customer journey is through complaints, as an example. And that is built on an evidence-based process to report on that experience. So we really need to take what we've learned in that compliance journey and in complaints or disputes as an example, and really look at how we can improve the journey across the organization. Improving customer journeys is hard work, and it's time consuming, and if you already have them, great. It's time to really re-review to see if there's a chance for digitization and further automation. If you don't have them, don't panic, but you really have to document and observe the real end-to-end process, and this means often sitting side by side with agents to see what is actually happening with the customer rather than gathering that anecdotal evidence. And through that process, make sure the lens is on identifying negative and non-value experiences. Question where there are manual interventions and where you can use your current technology to help reduce that manual intervention time frame. We always suggest that when you are improving the customer experience, you test that new process within your existing framework, usually through a pilot, to make sure that you work out the kinks before you roll that out to the entire organization. And the last point here is a really important one. You want to identify points where it's better for your customer as well as for your staff, and make sure you celebrate those successes. Redoing a customer journey is not just about making it more efficient and more effective. It's about getting everybody on board and excited about what you've done and how you can re-review and socialize those successes. So now I'm going to turn it back over to John, who will talk about refining underwriting.
Okay, great. Thanks, Andrew. So we've spoken with chief risk officers of a number of banks, actually, that arguably note that focus on the best credit is why, in large part, they're still standing today. And why is that? Well, let's be honest. When it comes to underwriting, the world grinded to a bit of a halt 9 years ago, and since that time, acquisitions have been about acquiring the easiest or less risky of loans. And what we're about to introduce is certainly something that we're not advocating that anyone necessarily chase profit down the credit curve and forget lessons learned. However, we do want to point out that the world looks differently today, initially based on the financial fallout, but now based on changing demographics and demands of the consumer base. So how do we get back to what we call smart growth? And smart growth is really a strategy that aims to understand the full segment that is credit eligible. We all know exogenous shocks that came about during the financial crisis have resulted in a bit of a perhaps a misclassification of high-risk populations. For example, there are obviously a slice of borrowers out there, non-repeaters, if you will, in this population that are creditworthy. And for lack of a better term, we call these folks rising stars. And then for numerous reasons, including millennials, changing socioeconomic and self-selection, no-file and thin-file populations are not only large, but also comprised of some sound credit risk segments. And we like to call that population the invisibles. So how do we know this? Well, let's look at the invisibles. In a recent finding last quarter by our friends at ID Analytics, reportedly 35% of new credit card applications are made by millennials. And that's 6 points higher than Gen X. Yet 1 in 5 people between the ages of 23 and 27 have been declined for credit multiple times within a single year. And then once declined, an overwhelming majority does not reapply for at least a year. And the biggest obstacle facing millennials in their struggle for new cards appears to be the credit scores. And again, ID Analytics reports that 67% of consumers under the age of 30 have a subprime or a non-prime credit score. And worse yet, around 33% of people in this age group do not have any score at all due to a lack of credit history. And other intelligence that we've gathered through research suggests that there are approximately 45 million adult potential borrowers who are unable to be scored, and that represents about 20% of all eligible borrowers. There's another, well, I guess within that, approximately 26 million adult potential borrowers with no, and I mean zero, zip credit history in the U.S. Traditional credit bureaus, and 19 million with limited, thin or unscorable credit history. So when you put it all together, this presents tremendous growth opportunity. And further, due to digitalization and emerging market disruptors, the invisible segment increasingly includes prospects who are thin by choice. And there are a variety of studies and opinions on the topic of thin by choice. I've personally seen varied estimates of the number of consumers that fit that description, as well as their purchasing power. For example, I saw one estimate that suggests that there are roughly 80 million or so consumers between the ages of 18 and 34, and their purchasing power is greater than $1 trillion in the U.S. alone. This study, I think, came out about a year and a half, 2 years ago already. But regardless of the actual numbers and the source, the consensus is that this notion of a thin by choice population is germane and certainly creates an amazing addressable market. So more specifically, what kinds of things can we do to go about refinements in underwriting as many are reopening their risk appetites? Well, first we can leverage existing data for these rising stars. Second, we can recognize the need for new data for the invisibles. And I think folks are stepping back into this, and what we see, they truly appear to be leveraging a hybrid model between some auto and manual underwriting. And the best ones actually, having performed consistency reviews and have done some things, put controls in place around their manual lending so that they can have confidence in it and not fear it. And this truly helps more effectively manage risk and get to yes when looking for those rising stars and I guess you could say diamonds in the rough. Of course, with anything, we always suggest measure, monitor, and test. Refining these strategies should be a measured activity. Champion, challenger, new types of variables and strategies is ultra critical. And again, this is probably a good point to remind folks to connect the dots, as we talked about earlier, to really ensure the front end and the back end are in sync. We also want to make sure lenders, of course, are trained and skilled. So the last thing we want to see happen is as you think about growth as an organization, we don't want to turn the spigot on the front end and not be ready to handle a rise in losses on the back end. So the clients with whom we work are proactive and they're thinking about that. They're designing products with these opportunities and foundations in mind. In terms of some specifics on how we can find the rising stars, just a couple ideas. We suggest review of current credit policies to determine if some of the current underwriting rules are automatically rejecting applicants in a way that prevents an organization from discovering their credit story. And this would also, by the way, apply to portfolio management strategies. We would encourage examination of those to determine if some borrowers might be excluded from entering a credit line increase strategy, for example, who could now be a good risk for increased credit. And we actually have a specific example Andrew can speak to from a client of ours that had a situation where over 80% of its portfolio were hard knockouts for credit line increases due to legacy criteria added during the financial crisis. Of course, the other items here assess how we're determining the ability to pay, consider various sources to verify income and cash flow. There's a number of new ways to do that now or test into it. Conduct analysis, leveraging credit history and scores to create really the customer story. And again, there's a variety of factors that may have happened during or emerging from the crisis to previously good customers. This could be in the form of bankruptcies, first-time late pays, defaults, foreclosures, etc. So it's helpful to analyze the data and identify are these truly repeated observations of the same variables over a period of time, or was this sort of a one-off? And then lastly, taking calculated risk to separate the difference between the always bad and the recently bad due to the crisis, and or will not likely be bad again. And as always with any new strategy, ensure that the organization implements appropriate processes and controls for testing, monitoring, and refinement of strategies. The Invincibles, shining light on this population, we have a few ideas here. First, we can consider the data available from national credit reporting agencies for potential customers with thin to no credit history at traditional credit bureaus. And this data can provide some insights into payment history. This includes verifiable income, cash flow, bank statements. We see folks doing some work now with mobile phone and utility bills that are becoming quite relevant, as well as leveraging the new data sources to build revised models with a focus on using more variables than previously considered. And certainly changes to what is being reported is going to drive changes in the scores. Public record data, for example, is dropping out of the FCRAs, and that will certainly have, we think, some pretty big implications. Lastly, of course, there's always test into the space and then measure, monitor, and test again. And then we have just a thought, maybe an exercise that might be worth trying at your shop. We would encourage you to think about maybe testing or pulling some data files for the 21 to 30-year-old segment and comparing 2006 and 2015 data if it's available. And how have the credit history, income, and DTI distributions changed within this population? What are the difference in decline drivers? And after looking at this and examining the differences in decline drivers, there's an opportunity to identify any variables that might be able to build into strategies to provide either a second chance for applicants and customers that perhaps were overlooked or might now be overlooked. And we thought we'd serve this up today. It might be an interesting piece of analysis. With that, I'm going to hand it back to Andrew.
Okay, thanks, John. We've got our third poll question here, and this is going to relate to our next segment, which will speak to the future of collections. So here we're looking to understand what contact channels does your organization use today in collections when interacting with customers. And unlike the other poll questions, you can select all that apply here. Okay, so as we see these roll in, the opportunity is quite large in moving into the digital space for collections. And we've been talking about ways to innovate your business and leverage the foundations that you've built over the last 5 years to speed up that process and minimize costs. And perhaps the the largest area, the ripest area for innovations is collections, and honestly, innovation there is a must. The future of collections has and will continue to change, but you really don't need to take my word for it. Let's look at some statistics. So in the year 2000, there was about 465,000 telemarketers in the U.S. That number's almost cut in half to 226,000 in 2015. So the phone channel is certainly waning. In 2003, there were only 2.5 U.S. homes without a landline. And that number in 2016 has jumped to 48% of U.S. homes without a landline as everybody moves to smartphones. There were 18% of Internet users who banked online in 2000. That number has skyrocketed to 61% of Internet users who banked online in 2013. And 53% of smartphone owners used mobile banking in 2015. So the shift here is definitely over to more of the digital space. And really, why does this matter? And I would say that the title of this slide needs to change a little bit. The world has changed around us. The consumer is now in control of how they interact with their providers. Chances are most of you on the phone will use one of these services in the next few days. Hopefully none of you are using them right now. But if you looked at the examples that we have here, Uber and Lyft are great. We used to have to compete for cabs by waiting to wave one down in the streets in the rain. Now we are in complete control. We request the ride with the push of the button, and it's up to the drivers to compete for us and who can respond first. Airbnb is a great example. I threw that one in there. I love it. They're a room renting service, but they don't own any properties. So there's no concierge, there's no building. They are simply leveraging the inventory that's available out in the market and providing an avenue for homeowners or property owners to rent their properties. And then you have Netflix and Amazon. I can still remember the days of scouring Blockbuster to try and find the right movie and then walking up to the counter only to find out that it wasn't in stock and you had to go back and pick out another one. Now, not only do I have access to any kind of content that I want, but Netflix and Amazon is proactively providing suggestions for content that they want me to watch. It's often content that they've produced based on my recent activities to meet my consumer preferences. So these are some pretty fun facts to illustrate how the world's changed around us, but we don't have to just rely on that. If we looked at delinquency rates over time, you can see that we've been in a lull, thankfully, because we had so much else going on after the crisis but we needed a break. But we're starting to see a rise here if you look towards the tail end of the graph. And we expect that rise to continue because less than 2% delinquency rates are not normal when you're trying to grow your business. And as we saw in the CBA Live survey at the beginning of today's webinar, most of our clients are absolutely focused on growth. So I would argue that the trend from 1995 to 2005, so the beginning of the graph to about the middle of the graph, is an acceptable one in a growth state. Now, one could argue that the lower loss curves are because we've gotten so much better at risk management, and while that might slightly be true, we believe it's a result in the changes in underwriting because of the crisis that just haven't returned to normal yet. And my inbox has been flooded over the last month with articles around household debt increasing in the U.S. and around how innovations really are a must in collections. And there's a reason for that. Collections is drastically different. We have to bring that cutting-edge technology and innovation together because there's a true shift in the way the consumer will engage with your collections and recovery agents. Really, the number one idea that gets missed here is the idea about thinking about the value proposition. Nobody goes to market without thinking about the value proposition. But why would that be any different in collections? How do I get the consumer to want to work with me, and how do I get to the customer to choose me over the competition? This shift really changes everything. Like we've seen in the examples for Uber and Lyft, Amazon and Airbnb, you're competing with limited resources with other creditors, and you will be competitively disadvantaged if they've taken the steps to advance and you have not. And by the results of our poll, I think there's a lot of opportunity for us, those on the phone, to start thinking about how do we innovate in this space. So the question really is, how can you leverage your foundations to enable the future of collections? And really that's by taking all of the capabilities built elsewhere in your organization. You can pull that through to collections. You know, we have clients that are working to bring that cutting edge technology into collections. And one of the ways to do that is through innovative analytics and segmentation. There are internal data sources. As an example, the information that your marketing department already has and buys that could be brought in to supplement your loss mitigation process. And the example here is, it would be great to understand the channel that the customer was marketed in, the channel they responded to and applied through. Knowing that channel preference would help you determine how that customer prefers to communicate with you. And you should be communicating with that customer through the collections channel. We also have integrated customer journey and team member experiences. When you're thinking about digital solutions and operational processes, you need to enhance that shared experience among all parties. If you remember the customer journey example that we covered a bit ago, we achieved an increase in customer and employee satisfaction because the customer and the agent had access to the same information in the same channel and in real time. And you need to be able to carry that over into your collections organization. Finally, you've got deliberate data and compliance infrastructure. This needs to be a forethought and not reactive, and that'll help you result in efficiency. You know, data quality, which we'll expand on later, is going to be crucial to staying compliant, and that's a fact that we're all familiar with. We can leverage automated controls and processes that are already in place for collections, but we really have to look at the lens to see if they're being maximized to their fullest potential. And we have to optimize our channel contact models. If you think back to the earlier stats, you have to ask yourself, are you communicating the way your customer needs you to do and really wants you to do? So in other words, there's really no need to reinvent the wheel here. There are decision systems in other areas of the bank that regularly use risk analysis, segmentation, and workflow management in the digital space that can be brought over to collections. And even dialers, while they were commonly the workhorse for larger collection shops, and one could argue they're on the ropes a bit, can be augmented with lessons learned by looking at self-service VRUs and IVRs from other functions like marketing and customer service as an example. Really the message here is you have to have the same consistent end-to-end customer experience in collections that you do with the originations. Integrated customer views is a great example. Being able to look at your account view and history and see that information at a glance. Having payment capabilities that are convenient and simple for your customer. And online tools that allow your customers to input their information in their own time to guide their decisions. And that really folds over into the next portion of the slide around relationship management. And that's looking at the entire consumer profile, not just with that account, enabling customers to request contact times that are convenient for them, which will increase your right party connects. And this third one's a bit scary, but it is very important today, and that's the solicitation of the customer opinion of their default management experience. Giving the customer the opportunity to tell you how they're feeling about that experience will help reduce complaints and also will help you not only respond to that specific customer, but also improve your processes. And then finally, I'll just touch on preferences. Enabling your customer to set the contact preferences and understand what their contact patterns are beyond just the phone, beyond the form letter, are going to be critical to enabling the future of collections. So what can we do right now? Well, we work with a lot of clients that we consider best in class, and they've developed a future state plan that incorporates these success factors. The first one is balancing the need to be realistic in what can be achieved while not allowing the current state to be a hindrance to your future state vision. This is not an all or nothing scenario. There are a number of solutions in the market today that are off the shelf that can help close the gap in your current state, and we'd be happy to talk to any of you about some of those solutions. You really have to make sure that the vision is credible and that you have defined your short and long-term goals. It cannot be, we need to have a web-based self-service offering. It's a bit of baby steps. How can we leverage our existing technology, defining the requirements, and then understanding what's out there in order for you to achieve those requirements. And you have to build momentum. You have to market quick wins effectively across your organization. And going back to another poll question, that's going to help generate that momentum and that urgency around the need for innovations. And what a better place to do that than in collections. You have to really consider the inevitables in this equation, and you have to hold those constant. This is not an if scenario at all. It is absolutely a win scenario. Outbound calls are definitely going to decline in the future. The only question is whether it will be due to effectiveness or to regulations. Digital capabilities will eventually be the norm in collections. And the role of the human collector will evolve as the interaction model changes. And you have to keep that in mind as well. Just because you go digital doesn't mean you have to not pay attention to the phone channel. That's going to continue to be a phone channel. And those agents that are speaking to customers are often going to need to speak about more complex situations. So you really need to make sure that your agents have the training required to handle those complex situations. And then finally, it's determining what must be true for the vision to become reality. And that is all around data. Accurate, consistent, real-time data is moving faster than ever before. Those phone calls that I talked about being more complex and sensitive, you have to ensure your agents are prepared. And that's really bringing that data to the forefront and understanding how it can be used in your current state and where you need to get to it in your future state. So I'm going to turn it over to John, who will talk about automating compliance checks.
Okay, very good. Thank you. So watching our time here, this is the last section, the home stretch, and admittedly probably the driest part of the material, but I would submit probably some of the most important because we spend a lot of our time focused on this on a regular basis. And again, back to the original or opening remarks, while there's been a lot of investment to date in compliance, there is still room for automation and innovation. And first, it's imperative to ensure data completeness. We all consume data, both internal and external. It's the lifeblood of what we do each day. It's not just about complying with regulatory interest. How we go about doing it is key, really, to being positioned for success and growth. Data completeness is also about knowing what data you have, what data you have to furnish, and how to use existing data in conjunction with new data sources. As institutions are collecting more and more data, the infrastructure in place becomes critical in gathering complete, meaningful data. And we all want to ensure that our data, of course, is of high quality. Second, we must ensure accuracy by monitoring that data. Too often do we assume that the logic was coded in a way that information is moving back and forth between destinations as intended or desired. And believe me, we've seen many examples where that's not the case. So and how can we really be certain unless we're checking on it? And then third, monitoring, it is critical but not always efficient. So it helps to do so efficiently through use of automated tools. And most lenders truly should already have some of these pieces in place. And if so, that's good. You're probably in a position to direct attention to new and more advanced things. If not, it's probably a good idea to make it a priority and make sure that that's in place, because they really are preconditions to grow into new areas and hot areas in the industry. Back to some of the things we talked about with underwriting, which would otherwise, I'd say, be challenged to leverage some of those new things for example, use of non-traditional data if this was not in place. So, for example, quickly, let's talk about furnishing of data to national credit agencies. We can spend a lot of time on this in and of itself, but having high-quality, accurate credit reporting data is a key need in making lending decisions, of course, and consumers also rely on this data for many important needs in their lives. We all understand that transmitting data to credit bureaus follow the Metro 2 format specs, which is an electronically and standardized format. It's certainly an extensive spec. It's designed to normalize a wide range of credit history information while complying with federal laws and regulations. But what would typically be a near impossible manual effort can be achieved in a mere fraction of time scrubbing against Metro 2 criteria and rules. The plug here is that we did develop a tool to make ourselves more effective and efficient in our consulting engagements, frankly, and data assessments. And at the request of clients, we're asked to commercialize it for their use. So in response, we did. And for example, if we just talk about furnishing data to national credit agencies, this is sort of a view of how we can run this not only as a check, but it's also a great tool for retro analysis for new system updates. So typically when we run this, we see where there's discrepancies that are unearthed. We've processed millions upon millions of records at this point. We've never seen, or I've never seen, a scan of a file that did not at least trigger a handful of the rules as being potentially a discrepancy. Some specifics, what can be done right now. Certainly, we have clients that have started to automate compliance checks. They're streamlining data. They're looking to reduce unnecessary and duplicative reporting. They highlight operational gaps. This certainly serves as a benefit. Requires fewer resources. You don't have to chase down as much data. It allows technology on the back end to be more efficient once it's in place. Reviewing what's in place currently, determining the end state, what information are we seeking, where's the proper form for this information, where does the data exist. Of course, understanding what other solutions are out there in the industry, determining what constitutes complete. Are there laws and regulations that apply? Are there investor guidelines that need to be met? So on and so on. What types of things are is our industry measuring? And even more recently, are there specific targets employees need to hit for the incentive scheme? So what historical data needs to be summarized to show meaningful trends? At that point, we typically see some type of gap analysis comparing what's required to what's available. And if there's any missing data, how is that captured within systems? And then, of course, testing into it. And then lastly, executing, taking to task, lay out a plan to close out those gaps and identify anything that has been deemed as data incompleteness, find ways to bring those to close. This probably sounds easier said than done. We realize that, but we found that once lenders have made this a priority, it really isn't as painful as it sounds. In fact, to the contrary, it actually removes some pain of the manual processes. And then having lots of manual compliance checks not only uses a lot of time and resources, but of course it opens up the door to risk. So those that are automating these checks can free up many of those resources to be allocated to other areas of the institution. With a few moments left, let me hand over to my colleague for some closing remarks.
Thanks, John. So let's try and tie this all together. We've talked about the prerequisites, the key elements you should have in place as the foundation for enabling the innovation we've discussed. And the clients we've worked with in these four areas all had some of those elements in place before they started. So regarding the customer journey, existing process mapping, the work that's been done on lines of defense and KRIs can absolutely be leveraged to help looking at your customer journey, really mapping out what that real journey is and improving that. Regarding refining underwriting, anything that has to do with fair lending and model risk management, the revision of policies and procedures as a result of some of the regulatory actions and operational risk frameworks can be leveraged there as well. With regards to reimagining collections, you've got your operational risk frameworks, evidence-based controls, and vendor management processes that probably exist that can be leveraged also. And then finally, on automating compliance checks, credit reporting disputes, process mapping, and evidence-based controls are there, and they can be leveraged as well. So all that said, however, we've been living and breathing this for a while, and while it may seem like old news to us, it might not be to some of you on the phone, and that's okay. We still find that 3 lines of defense and how they are defined and executed upon are not as mature or as effective in some organizations, and that while policies and procedures may exist in some functional areas, they need to be updated for others to adapt to the times. Fraud and authorizations are great examples of areas we didn't have time to discuss today, but are often areas that are hot buttons for growth that we can certainly discuss at a later time. So that said, let's move on to our final poll question, which would be, what takeaway from today's webinar would you likely address? Select all that apply, and then after we give this a minute, we'll go ahead and turn it over to you for questions. All right, so it seems like the trend starting to emerge here, and absolutely improving the customer journey is a focus for a lot of our clients, as well as looking at identifying new customer segments to enable the growth that we all want to achieve. So, all that being said, I'd like to thank everybody for their responses to the poll questions, and in the few minutes that we have left, go ahead and open it up for questions.
And just as a reminder to the audience, if you'd like to submit a question, just enter it through the web conference system. Simply type your question into the chat box area at the lower left corner of your screen, and then make sure that you click on the send button to submit your question. So Andrew and John, I'll turn it back over to you. Gentlemen,
okay.
Are you there?
Yeah, we're still here. I'm waiting for questions, but apparently we've either put everybody to sleep or there's a lot of stuff to ponder. So I would like to remind folks that if you have a question, you can just send it to the leaders, or if you'd like to submit it through the webinar, you can go ahead and do that, and we'll happily go ahead and answer some of those questions. We've just gotten one that's come in, and it's, given the work that we've done in the industry, how long does it take to review and refine a customer journey? I would say that that answer depends. I would go back to the case study that we leveraged at the beginning of the webinar and say that took 2 of our resources for approximately 5 months. And it's important when you're looking at that activity that you dedicate somebody, whether it's internally or externally, to really identifying what the real journey is. It's very difficult for folks to do this in addition to their day jobs and to be able to map out or chase down what exactly happens with your customer. I would say on average, depending on the size of your organization, it could be a light resource need, 2 to 3 people for anywhere from 3 to 6 months, depending on the complexity of your journey. I hope that's answered the question.
With that, I think we are at the hour. So, Sandy, we'll look to you for the wrap-up.
Excellent. Very good. Thank you so much. And if you have any additional questions for our speakers, the meeting room will remain open for a few minutes after we sign off today, so you can submit your questions. I believe the speaker's contact information is also here on your screen, so you can certainly get in touch with them that way. So with that, we will conclude today's program. This session has been recorded and will be available within 3 to 5 business days. You may access the recorded archive by using the same login information that you used for today's live webinar. You will also be receiving a follow-up email, and then feel free to share the recording link with your colleagues. On behalf of the Consumer Bankers Association, thank you to our speakers and, of course, to all of today's participants. Have a good afternoon, and you may now disconnect.